Have you ever wondered what could bring down one of the most powerful institutions, the greatest Silicon Valley bank? What sinister secrets lie hidden beneath the polished exterior of the tech world's favorite bank? Brace yourself for the shocking truth, because the story of the Silicon Valley bank's downfall is a dark one. A tale of greed, deception, and corruption that will make your blood run cold. In this video, we will uncover the harrowing events that led to the ultimate demise of the Silicon Valley Bank and reveal the terrifying truth. We will also look into what problems this crash has created across the world. Get ready to confront the darkness that lies at the heart of the tech industry as we delve into the secrets of the Silicon Valley Bank's catastrophic collapse. Silicon Valley Bank, the financial powerhouse that had long been the go-to for tech entrepreneurs and venture-backed companies, was a behemoth of the banking world. With assets totaling a staggering $209 billion, nearly half of all venture capital-backed tech and healthcare firms were financed by SVB. But all that glittered was not gold, as the bank's downfall revealed. Despite appearing to be in sound financial condition just days before, the bank collapsed, sending shockwaves through the tech industry. And while the bank's clients, including household names like Airbnb, Cisco, Fitbit and Pinterest, reeled in the aftermath, a darker truth emerged. It turned out that nearly 87% of the bank's deposits were uninsured, leaving many questioning how such a catastrophic collapse could happen. The global events of 2020 brought about unprecedented change, with the tech industry being no exception. Silicon Valley Bank, known for its heavy skew towards serving tech companies, saw an explosion in deposits during this time, skyrocketing from $62 billion in March 2020 to $124 billion in March 2021. The bank invested most of these deposits in long-term treasury bonds, hoping to reap higher returns than shorter-term bonds could offer. However, as the 2021 to 2023 inflation surge saw interest rates rise, these long-term bonds became less attractive as investments and their market value fell sharply. In April 2022, the bank's chief risk officer stepped down, and a successor was not named until January 2023, a period coinciding with the interest rate increases. By the end of 2022, the bank's mark-to-market unrealized losses for securities held to maturity exceeded a staggering $15 billion. This, coupled with a wave of startup companies withdrawing their deposits from the bank to fund their operations, left SVB struggling to raise the necessary cash to fund these withdrawals. The bank was forced to sell all of its available-for-sale securities, incurring a $1.8 billion loss. The bank faced heavy criticism for its timing in announcing its financial troubles, which coincided with the winding down of operations of Silvergate Bank, a bank that catered to cryptocurrency users. Furthermore, SVB had not secured private funding ahead of the announcement, leading many to question the bank's overall strategy and preparedness for such an eventuality. Since then, experts have suggested that the Economic Development, Regulatory Relief and Consumer Protection Act, passed in 2018 and backed by Greg Becker, CEO of SVB, might be to blame for the bank's demise. This legislation reduced the frequency and number of scenarios of required stress testing for banks with under $250 billion in assets under the Dodd-Frank Wall Street Reform and Consumer Protection Act. Some experts believe that had SVB been subject to more rigorous stress testing, they may have better managed their risks and avoided the catastrophic collapse that ultimately led to the bank's downfall. As the tech industry reels from the collapse of one of its most trusted financial institutions, questions linger about the future of the industry and the potential ripple effects that may be felt for years to come. The days preceding Silicon Valley Bank's demise were fraught with instability and uncertainty. Moody's Investors Service warned SVB Financial, the bank's holding company, of a potential credit rating downgrade due to the bank's unrealized losses. On March 8th, SVB made a desperate move to sell over $21 billion worth of investments, borrow $15 billion, and hold an emergency stock sale to raise $2.25 billion. Despite these measures, Moody's still downgraded the bank the same day. A number of venture capital firms, notably the Peter Thiel-led Founders Fund, encouraged their portfolio businesses to remove their bank balances. Clients hurried to withdraw their monies, reaching $42 billion at the end of the day on March 9th, exposing the bank with a deficit cash position of over $1 billion. The Founders Fund withdrew all of its funds from the bank by March 9th in order to escape the effects of SVB's failure. Venture capital firms advised their portfolio businesses to do the same. The value of SVB's shares plummeted until trading was halted on the morning of March 10th. The situation was made more controversial by the fact that SVB Financial Group CEO Greg Becker had sold 12,451 shares of company stock worth $3.6 million on February 27th through an executive trading plan that he had filed with the SEC under Rule 10b5-1 on January 26th. This rule has been criticized as a loophole for insider trading. The SEC will now require a minimum 90-day cooling period for most executive trading plans from April 1st, but it came too late to prevent the fallout from SVB's collapse. The collapse of Silicon Valley Bank, which occurred on March 10th, 2023, has sent shockwaves throughout the financial world. Regulators from the Federal Reserve and FDIC arrived at the bank's offices to assess its finances, ultimately citing inadequate liquidity and insolvency as reasons for taking possession of the bank. The FDIC established the Deposit Insurance National Bank of Santa Clara to reopen the bank's branches and allow access to insured deposits, while also beginning an auction to find a buyer for the failed bank. Uninsured deposits at the bank were estimated to represent 89% of total deposits, but the FDIC expects to cover these with special dividends as assets are liquidated. Employees at Silicon Valley Bank were informed of their planned layoffs. However, the FDIC granted hourly workers double pay for overtime and salaried workers a 50% boost instead. Despite the fact that the Treasury Secretary has rejected the idea of saving the bank, the Treasury, Federal Reserve, and FDIC said on March 12th that all depositors will be compensated without the use of government funds. In order to combine insured and uninsured deposits into a single organization and make it more appealing to potential purchasers, the FDIC moved SVB Holdings to a new bridge bank, Silicon Valley Bridge Bank, and named Tim Mayopoulos as CEO. Although the Canadian regulators seized all holdings of SVB's Toronto branch, the Bank of England pursued a court order to put the bank's United Kingdom affiliate into a bank bankruptcy process. The joint activities of Shanghai Pudong Development Bank and SVB were unaffected by the collapse. Preliminary bidding of Silicon Valley Bank assets on March 12th drew a single bid, which the FDIC rejected. Now that the bank has been classified as having a systemic risk, the FDIC is able to guarantee all deposits. Therefore, there are plans for a new auction to solicit bids from big institutions. On March 13th, SVB Financial Group started looking into the possibility of selling the bank's sibling firms, SVB Capital and SVB Securities. The aftermath of the collapse has sparked an investigation by the Federal Reserve Board of Governors into the regulation and oversight of the bank, to be released publicly by May 1st. The loss of Silicon Valley Bank was the greatest bank failure since the 2007 to 2008 financial crisis, and the second largest failure of a federally insured bank by holdings, sending shockwaves through the financial world as regulators and prospective buyers seek to stabilize the situation. The recent collapse of Silicon Valley Bank, SVB, has had a significant impact on small seed-stage companies, including one startup that created all-in-one Asian sauce packets. Omsum CEO and co-founder Vanessa Pham shared her first-hand experience with the downfall of SVB, which forced her to send an SOS to her loyal customer base on Instagram to keep them updated on the situation. Pham emphasizes that the impact of changes made by large institutions and gatekeepers is often felt the heaviest by the smallest and most marginalized groups. For businesses like hers, having access to their funds is crucial to their operation, and the sudden loss of support can cause massive disruptions operationally, financially, and psychologically, especially for small teams like Omsum. Moreover, SVB was known as the lender of choice for high-risk tech startups that were deemed too risky by traditional banks. This made SVB a vital lifeline for companies like Omsum and Shelf Engine, which relied on its services to obtain credit and loans that they couldn't get elsewhere. SVB was particularly attractive to startups because it had a deep understanding of the startup ecosystem and was designed to cater to early-stage, high-growth companies. But SVB's impact extended far beyond tech startups, as it also found a lucrative niche in the wine industry. In the mid-90s, the bank opened a wine division and has since loaned approximately $4 billion to wine-centric clients. The bank's expertise in understanding the complexities of the wine industry and its unique financing needs made it the go-to lender for many family-run wineries. As Jasmine Hirsch, the winemaker and general manager at Hirsch Vineyards, explains, having a partner that understands the timeline and how to support borrowing in the wine industry is crucial. While there are other lenders available, SVB's concentration of expertise in the wine industry was unparalleled. Despite experts' belief that Silicon Valley Bank's collapse may not have a systemic impact on the US financial system, the fallout from the crash has caused significant hardship for many tech startups and businesses. Companies holding large, uninsured deposits and low cash flow are particularly vulnerable to the risks created by the bank's downfall. The effects of this collapse may be temporary, but the challenges faced by those impacted will undoubtedly have long-term consequences. As the story continues to develop, it remains to be seen what the lasting impact of this event will be on the broader financial landscape and the tech industry as a whole.